So when you think of whole life insurance, what typically comes to mind? Good things or bad things? I'm talking about a whole life insurance policy where we're focusing on the cash value, and I'm going to try and convince you that it's a good place to put money, not a bad place to put money. What do you think of when you hear of whole life insurance? Most people think that it's a bad place to put money, that it's a scam, we'll get ripped off. So what I'm going to do is go through why people think that. I'll go through the type of product or the way that a whole life insurance policy is typically sold and why that is. And then what you can do with that exact same policy to make it very attractive and really copy what you'll see corporations do and wealthy individuals do with whole life insurance where cash value is the goal. So when it comes to whole life insurance, usually how people purchase it or how it's sold is just as a traditional old school whole life insurance policy. And how this works is I would tell you for this whole life insurance policy where the death benefit amount is, $1 million, meaning if you die, this $1 million is paid out income tax free to your beneficiaries. It is going to cost you a premium of $20,000 per year. This depends on your age, but let's just say $20,000 per year. And it is a whole life insurance policy where the premium is due for your whole life. So you'll see it billed forever. Now you don't have to pay it forever, but most of these policies are set up where you will see it billed indefinitely. So you've got this $20,000 premium, and then you have the cash value here. So when it comes to the cash value, why people are attracted to it is because the cash value is safe, meaning there's no risk with it. It's not invested in or tied to the stock market. We see it continuously grow over time. It's also very liquid, so whatever you have in cash value, you can access anytime. I can borrow against it, and you'll find that taking loans or borrowing against your policy is very similar to taking a line of credit against real estate. You'll see that whatever you have in cash value is always compounding for you. So if I've got $10,000 in cash value, say it's earning 4 or 5%, and I borrow $5,000, I keep earning that 4 to 5% on my full 10. So there's no lost opportunity cost there. So that is what attracts people to the cash value and often is the reason why, or explains the why behind why someone puts money into a whole life insurance policy. Here's the issue though, because typically we're not smiling when it comes to whole life insurance, or most people are not, is with this traditional setup, I said, here's a death benefit of $1 million. It's going to cost you $20,000 per year. You will have cash value. However, it's zero in the first year. All of your $20,000 purchased a life insurance policy. That's what happens. The second year, it's a zero. That means you paid another $20,000. A total of how much? $40,000. $20,000 times 2 years. So this is $20,000 per year, just to clarify that piece. By the third year, you might see $15,000. So you make a third $20,000 payment, and you've got $15,000 in cash value. Might be a little bit more than that. But you've paid how much? So this by the third year, you paid $60,000. When you would finally see the cash value equal to or greater than what you've paid into the policy is usually somewhere between 10 and 15 years with a traditional setup like this. So let's say 15 years, because usually it's closer to 15 years than it is 10. By the 15th year, you would have paid in how much money? $20,000 times 15 years is how much? 20,000 times 10 is 200,000. Add another 5 years. That's $300,000. That's how much you've paid. Now, finally, in cash value, you see $300,000. Took 15 years to catch up for what you lost in the first and second year. So going back to the cash value, why are people attracted to that? Do you remember the reasons why? Safe, it continues to appreciate. Long term, I'll see a lot more than what I paid in. Long term's way more than 15 years, but it is safe. It's also liquid, so I can borrow against it while my money keeps on compounding. Can also take income on a tax-free basis in retirement. A lot of times I'll withdraw first and then take loans, but I can access my cash value. Then it's tax-free. Tax-free if we do everything right. So the tax-free piece is what attracts a lot of people to the cash value. However, this defeats the purpose, or it's so unattractive that people look at the benefits and say, I'm not going to wait 15 years to get my money back. I don't even want to wait 7 to 10 years to get my money back. How do I make the cash value more attractive? So here's the thing with this, and this is often how I'll explain it to a friend of mine or anyone really, is you can take the same whole life insurance policy and you, the policyholder, can actually choose where your money goes. So, for example, in the first example, this scenario, where did your money go? It all went toward the premium because I said, here's a $1 million death benefit. It's going to cost you $20,000. And you said, all right, if that's the only way it works, I guess I'll pay the $20,000. You seem like you know what you're talking about. Let's move forward. I wouldn't do that, by the way. The other way is with a whole life insurance policy, you can choose where your money goes. So what we're not going to do is say, here's a death benefit that costs X amount of dollars. We're going to throw that out the window. We'll just see where the death benefit falls initially. We can make it higher, but let's just focus on how to maximize the cash value. Sound good? So this will initially look like this. Don't worry, it will be high. So if you're going to fund, well, first I would ask, how much would you like to fund a policy with or pay into a policy where the cash value is safe, liquid, and tax-free, and you'll see the cash value immediately. And then depending on what number you have or how much you think you'll be able to add, we might adjust things. But for the sake of simplicity, let's say you are going to fund, you could also use the word deposit, this is money you're paying in, $20,000. And I take that number only because it's the exact same number we looked at initially, and initially your cash value was 0 in the first and second year. Here's the thing on this. Of this $20,000, ready? Because here's the fun part. You can choose where that money goes. Where can it go? That's the question. You can pay your money or direct your money toward the insurance premium, which in the first scenario was $20,000, or you can direct it toward what is called a PUA rider. PUA stands for paid up additions. How do those two areas work? That's the question. Because once you know this, well, now you know how to really get a lot of cash value and copy what corporations do with these products. Because they view the cash value as an asset on their balance sheet. Premium dollars. Of the $20,000, I'm going to set it as low as a lot of the top companies allow, which is 10% of whatever I'm paying. So $2,000 per year. Premium dollars. How much shows up in cash value in the first year? How much showed up in cash value with this option? 0. Remember? 0 in the first and second year of the $20,000. If the premium is $2,000, how much will show up in cash value? 0. If the premium is $2 million, how much will show up in cash value? 0. Now this does depend on the product. There's some products that give you some money in cash value in the first year. Some are 30% or 40%. But my point is the premium piece is going to hurt the cash value the most with almost every whole life insurance policy out there when you look at it, especially up front and especially based on the guaranteed values. So the premium dollar, we minimized to $2,000, and the reason why, because we want to know how low can we go. And all insurance companies are different. You'll see a lot of the top companies, we can go as low as 10%, but we want to reduce that. Why? Because this piece takes the biggest bite. There's my Pac-Man. out of my cash value right out of the gates. Whereas PUA dollars, we'll put the other $18,000 here. Guess what happens with this? Yeah. Shows up in cash value. It's money I can access. It accelerates the cash value growth. This is the key to accelerating the cash value of any life insurance policy. Now, the death benefit is important, even if you said, I don't care about the death benefit at all. Why the death benefit's important here is you'll see there's a taxable line with every policy. It has to do with this term, MEC, a modified endowment contract, which can equal taxes. So what we'll do is solve for the minimum amount of life insurance we need in order to prevent a taxable event. If you have questions on that, feel free to leave them in the comments below, or you could ask us if you're in contact with us. But my point is, we'll always solve for the minimum death benefit. Minimum death benefit equals minimum costs in order to prevent the taxable event from occurring. We've got other videos that provide a thorough overview of that. But here, now we've got a high cash value policy. So when we look at the first year now with this option, we won't have the full amount of PUA show up in cash value in the first year, but you're going to have, call it 17.5, let's just say 17,000 show up in cash value in the first year instead of a 0. Same out of pocket to you. This can be with the exact same company and the exact same policy. We're just setting it up differently. And remember the main point, you can actually choose where your money is going. We are choosing to put the minimum dollar amount of our money into the premium and the maximum amount into the PUA rider. I like to call the PUA rider a cash dump-in. I feel like I'm dumping money into cash. It does buy me some death benefit too. You'll see that when you look at an illustration. But the cash value is why people are interested in that. So the first year, I've got 17,000. The second year, I might have 35,000. Remember, I'm beginning to earn dividends and interest now. And by the fifth year, how much would you have paid into the policy? $20,000 times 5 years is how much? $100,000. You would see right around $100,000. That's when you get your money back instead of 15 years later. So by setting it up like this, you get a lot more cash value up front, an earlier break-even point. If you were to look at the same 15-year mark, a lot of times the difference is drastic. The option to the left, you had 300,000. This is going to be closer to 370 to 450, depending on the company, product. Our age and health might have a little bit of an impact there too. It's going to be significantly different there. It might not be 450. I might have overshot it there. My point is we'll have more from start to finish there, which is really what we want to see if cash value is the goal. Because now what we're doing is taking the benefits of the cash value. What are they again? Remember why people are attracted to this? Safe, liquid, the loan piece, and tax-free income, and then the tax benefits. If I do everything right, for example, if I prevent a MEC from occurring or another taxable event like cashing the policy out, if I do everything right, I can access it tax-free. So here's why people are interested in whole life insurance. Why they typically don't do it is because they look at the cash value and it looks like this. It just takes a long time to get their money back. And they think, why would I do this? Some people outright express this. I remember years ago, this was at the very beginning of 2021, I'm speaking with him and his wife about whole life insurance. He had looked at it before he connected with me. He was looking at funding a policy with 7 figures per year. And the prior agent that he connected with, he asked them, he said, why would I do this? Like it takes 10 years just to get my money back. It doesn't make sense to me. And then we looked at, well, here's how you can do it to set it up for more cash value from start to finish. Now all of a sudden I see, okay, that's a minimum hit up front. I'm comfortable with that. I quickly get my money back. I see the compounding over time. I can access it. I see long-term. I can take income tax-free. I've alleviated the big pain point of seeing this big hit of cash value up front. And there's a lot of different ways to do it too. So some additional information, we can set it up where the first year, I'm at 17,000 here. Let's do it this year. I can set it up where it's really bad. And in the first year, really bad, okay, and great. Bad means I have zero cash value in the first year. Okay means I've got somewhere between 40 and 60%, maybe 70% of my payment in cash value in the first year. And then great means I have somewhere between 80 and 90%, sometimes it's more than 90% cash value in the first year. By the way, this can all be with the exact same product with the same company. So we don't want to compare different products with different companies, keep everything the same. And when we just improve one product, do we see an improvement there? And then we can take it further from there. If we say, okay, based on your situation, I would recommend this product with this company. However, just to keep things equal, so we've got a fair fight in the beginning, we want to use the same company and same product. And how do you simply maximize what people with a lot of this are doing with this? Whole life insurance, that is. So I hope that made sense. Let us know your thoughts and if you have any questions at all. And as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.